when we talk about how much a house is worth, that's always in some ways a subjective process. So we try to create some objective criteria to put some standards in place to how we would do that. But in reality, it's always fairly subjective. And tracing back to the 1930s, when our federal government decided to get involved more drastically in the housing market, and this was FDR, New Deal. It was an era where, because of the Great Depression, housing was really creating a huge economic crisis. And so the federal government was like, we have to do something about this. And part of doing something about this is to standardize how we evaluate houses. And so that's when the appraisal industry really became like a profession in the way we know it. And the federal government put out the 1936 underwriter manual that first really put the sales comparison approach on the national map. So that's a whole bunch of jargon to just say that if you go to sell or refinance a house, you might be familiar with the reality of an appraiser. And this is a market appraiser. So somebody who's working or getting paid via a lender usually is going to come to your house and they're going to evaluate your house. And how they figure out how much it's worth is really by selecting similar houses in a similar location. And that process is called a sales comparison approach that the federal government instigated. But what's really critical about that approach is, since the 1930s, there's this understanding that the main thing that's going to drive that value is similarly located comparable properties. And what makes it similarly located? Back in the day, it was explicitly a racial and class definition. It was drawing maps. You probably have heard of this, or might have heard of this colloquially as redlining, right? But they literally drew maps and said, okay, these are the bounds of these are similar neighborhoods. They don't use those same maps today, but there's lots of research, mine and others, that show that appraisers still heavily draw on racialized understandings of spaces to figure out where those comps are. And so that's how they select how the prices in which then they base the value of your house on. Now, on the tax assessment side, it's actually a very different process. So if somebody isn't physically coming to your house, it's not regulated by those same processes that appraisers are regulated by. Instead, what the auditor does, which is a government official, is they take all the recent sale data. So they take that data that really was informed by market appraisers, and then they put that data into what's called a mass assessment model, which is just a fancy term for saying we're going to throw it in the computer and we're going to use basically basic algebra that you learned in middle school and thought you never needed. But understanding it is actually really helpful for understanding your taxes. And it's going to look at the relationships between things like square footage, location, if you had a garage, the quality of your construction, et cetera, to sale price. And when they look at all the recent sales, they create an equation, and then they use that equation to predict everyone else's house value. So why this is different than a market appraisal is, on the market appraisal, we're looking at one individual house and we're pulling similar comps for that. For the mass assessment, we're making one equation that works for the whole county. And that one equation then determines everyone's house value. Now, that equation does go up and down a little bit depending on your location, but it doesn't have what we would call mathematically like an interaction effect between the features in the location. Or another way to think about this is, in a market appraisal, you're going to have a very clear difference of price per square foot if you're in a neighborhood in Cincinnati like Curry Park versus a neighborhood like Price Hill, for example. But in the mass assessment, you might have a slight difference in overall value because of those locations, but the price per square foot is still the same because it's the same equation. So because we're using one equation for the whole county and how that equation is actually derived, that's what, as in your words, reduces or pulls in the bell curve, right? It's pulling everyone to the middle because it's using one equation for the whole county. Is that helping?
I think I get it. So basically, it's putting square footage in like Indian Hill, basically on the same level as square footage in East Price Hill, and
yes, exactly.
not really adjusting for the individual neighborhoods there.
Yes. You know, if you're in Indian Hill, you get an extra $100,000, or I don't know what the actual number is, but it doesn't change that slope of square footage. And so that's how it can pull, or that's why it does. But the other thing that matters here is tax assessments. You know, when we think about like income, if you make $50,000 more in income, that $50,000 gets multiplied by the tax rate, right? And of course, on the federal level, it's a little bit more complicated because it's progressive, and so your tax rate itself might actually change. But on the local level, at least in Cincinnati, for example, it's a flat tax rate. So it's, no matter how much more you're making, it's just multiply that by that. We also think about this with sales. If you buy a more expensive, I don't know. I'm sorry, thinking of an example, and I'm like, what have I bought recently? If you buy a more expensive desk, it's not going to have a different tax rate. It's like the same tax rate, right? And so we think about often, because that is our lived reality of taxes more often, that we're dealing with these kind of flat tax rates. We assume that if my property assessment goes up, my taxes are going to go up. But that's not how property taxes work. Now, each state, so given that you just said you're living in Kentucky, each state is a little different. There is some specificities here that are Ohio specific, but there is also a very general trend that assessment are not just, or the property taxes, are not just a flat tax rate times by your assessment. In Ohio, since 1977, we use what's called a reduction factor, which is just a fancy word of saying, when you pass a levy, you're not just passing a rate. So like when we think about sales tax being 6% or something, the levy isn't just a set rate like a 2% or a 1% levy. Instead, once it gets passed, it's actually becomes set in the amount of money that will be. So let's say it was like $1 million. Now it's just set at $1 million. So when reassessments happen, we don't all just pay more because of those reassessments. We'd have to still just pay that $1 million all collectively. But who pays what of that $1 million might shift if my house went up more or less than your house. So in the most recent assessment, almost all the parcels went up. So if it was just like your property value or your assessment value multiplied by a tax rate, everyone's taxes go up. But that's not what happened, because that's not how it works. Instead, did your property values go up more or less than other people's in the county? And so where we see these deductions in actual property taxes or much smaller increases like in white communities and more wealthy communities, what's happening is, yes, their property values also went up, but their properties values didn't go up as drastically as property values in communities of color. And as I already had noted, that's not because communities of color have all of a sudden seen like these rather huge sales. It's because we're using a different model that shifted the assessment values in communities of color more than it shifted the assessment values in white neighborhoods. And so because of that, and because it's all relative, that means even if your tax value or your assessed value, went up, your property bill might have gone down, because if it is relative to everyone else.
Thanks for checking out Local 12's YouTube channel. Click the links and hit subscribe so you can be notified anytime we post new stories.